Hopefully everyone can hear me. And thank you everyone for joining us for today's Money Gym Money Class, which is part of a new series of webinars we're running here at London Mutual Credit Union, all about helping you to make the most of your money. Last month's Masterclass, which was the first we did, looked at ways to set financial plans and to how to actually keep them. And then, so if this month's financial plans include borrowing, then this month's sessions for you. It's worth saying also that these webinars continue to be something which we are still piloting. So if we're a little bit rusty, or if the technology lets us down a little bit, please be kind and do bear with us. As always, a sort of a feedback form will be going around the back, so we can constantly look for new ways to improve. Other thing to say is, if you have got comments or questions as we go along, feel free to drop them into the chat bot at the into the chat box at the bottom of your screen, I should say. So without further ado, I'll crack on and introduce today's session. So I'm Ben West. In my role as business development here at London Mutual, I work to develop London Mutual's products and services and to promote them in the wider world. And today I'm joined by two of my colleagues. There's Antony, who those of you who attended last month will recognize. Antony heads up our credit control team, and he's passionate about finding solutions to debt and helping our members when times are sometimes tricky. And then a new face to introduce this month is Lubna Siddiqui, who is part of our loans team. She's here to share some of her experience of how loans and lending and the lending process works here at London Mutual, and perhaps to give us a few bits of inside scoop or some tips which may be beneficial if that's something you're interested in doing. So briefly, what we'll cover today, we'll be looking around lending, and we'll be looking at different types of borrowing, when perhaps it makes sense to borrow, when perhaps you should stop and think again. After that, we'll chat a little bit about the application process, ways that you might want to look at choosing a loan, how much it might end up costing you, and how lending decisions sometimes are made. And often when, there are lots of questions at this point around sort of credit history and things like that. So we'll be explaining a little bit more about how that works. And finally, we'll wrap it up with some tips and some details about the specifics of London Mutual, how we ourselves make those lending decisions and what our lending process is. And close up with perhaps a few tips that might be useful if you are thinking about applying for a loan with us. I think the final thing to say at this point, and just to caveat everything I'm saying, is that, as always, if you are looking for individual financial advice, that's not something which we'll be able to give you on today's call. And so if you ever do have any kind of questions about whether a financial product or an approach to your finances is right for you specifically, then you should seek independent advice. What we're going to be covering today is much more general financial information about things which are true in general, and which may apply to your situation, but we don't obviously make any claims that it's that we're giving you specific advice. So just to be very clear on that one. So I guess I wanted to sort of kick off with a little bit of a discussion with Lubna and Antony. Obviously, kind of, the first time I kind of came across these things, and growing up, we often hear from our parents or from our nans, perhaps, warnings about, don't get in debt. And so I guess the place I wanted to start off with you, Lubna and Antony, today was just a bit of a discussion around whether is borrowing ever a good idea. I think there'll be a range of views on that one, but I guess it would be interesting to hear from you guys what your thoughts are on that.
Yeah, no, definitely. Hi, everyone. Yeah, I think borrowing is definitely a good idea. I think it goes down to a conversation about borrowing, of smart borrowing, good debt versus bad debt. Are you going to borrow? Are you going to take out a loan and borrow money for a financial goal? Are you taking it out for a short-term goal? I think you've really got to understand them questions before even thinking about borrowing. I think sometimes as a culture and a society, we were like, oh, don't borrow, don't do this, don't do that. I think it does boil down for, individual purposes and reasons why borrowing, and, you make your own assumption of what you need to borrow for. And hopefully today we can sort of give a bit more insight about actually our tips and hints around borrowing for individual reasons.
And Lubna, anything to add on that one?
I would say yes, in a sense that it can be used for about just about anything. For instance, if you don't have or don't qualify for a low interest credit card, or the credit limits on your credit cards that don't meet your current borrowing needs, then a personal loan is like your least expensive borrowing option, and you don't have like any collateral attached. Um, you might also probably, sorry.
No, go ahead, Lovely.
I was going to say, you might want to consider a personal loan if you need to borrow like for a fairly short amount of time. So if, for instance, you have like a lump sum of money that you owe to someone, but you don't have enough cash flow in the meantime, then taking out a personal loan will help to bridge that gap.
I think that's, yeah, and I think that, you know, we'll explore some of those kind of concepts, because I think you've mentioned some of the kind of some interesting areas to explore there. We'll talk those in a little bit more detail throughout the rest of the session. But I think, I guess the overall sort of theme, and I guess the summary, which I think, you know, of what you guys have just said and which we'll go into, is that I think it's, you know, it's probably wrong to say that borrowing is ever definitely a good thing or ever definitely a bad thing. It's much more about kind of making that individual decision as an individual based on your circumstances, your reason for borrowing, and the type of borrowing that you're doing. So we'll go into that a little bit more detail in a second. I guess the next kind of issue I wanted to talk about, and I think, you know, as I say, it's hard to say any kind of hard and fast rules, but I'm interested in giving people a bit of a feel for when they might want to consider it as an option, and then which situations are absolutely a no-no. So I know, Lubna, obviously in our loans team, you see lots of kind of applications for loans which are successful. So I wondered whether you just wanted to talk a little bit about the kind of the situations when, you know, we are likely to, you know, be able to help someone, and particularly the types of things that people might be interested in borrowing for.
So a lot of our MLD Army members who join, they apply for a debt consolidation where they might owe a substantial amount of balance on one or more credit cards with high interest rates. So taking out a personal loan to pay them off could save them money. The difference should allow them to pay the balance down faster and pay less interest in total. Plus, it's much more easier for them to keep track of one debt obligation rather than multiple ones. Also, we have a lot of members that apply for house appliances. So a lot of people might have like a washing machine or a cooker breaking down. So they might want to do some home improvement. So taking out a personal loan could be much more cheaper than financing through a seller or putting the bill on a credit card.
And we'll talk a little bit about how to compare the cost of different types of lending in a minute. But I think that's a good point, that often sort of the credit provided through sort of you know, stores and sellers and things can be quite high. Antony, obviously, you know, in your role at credit control, sometimes you sort of see examples of where lending hasn't worked for people who have borrowed elsewhere in the past, or things like that. What are sort of your best examples of where borrowing usually isn't a good idea, or where you'd sort of tell people to sort of stop and think again?
Yeah, no, I think quite, you know, given the current situation at the moment in the last couple of years, the day-to-day living cost, I think, is is increased a little bit. So a lot of people would tend now to take out a loan for their day-to-day living costs, or, you know, then their head's just underwater and they take a small loan, high interest rate, just to pay off their current loan payments or current expenses. And that tends to backfire sometimes when you're taking a loan out for general living expense. Then the ones that have creeped up more sort of in the credit industry at the moment are the ClearPay, Klarna, you know, instant shopping, pay it off, high interest rate over 6 weeks, 3 months. We're seeing a big increase on very small loans, payday loans, impulse buys, gambling, that, you know, or I'm only going to take a small £200 loan and I'll gamble 100 and put another 100 back into my savings, or pay it off my credit card. So yeah, we're seeing quite a lot of small loans, high interest out in the market, and a lot of people are sort of snapped up and taken to very quickly.
I think it's fair to say that, you know, particularly in cases where, you know, we can, you know, where we can sort of see that someone's applying for a loan, and, you know, perhaps there is a problem with gambling, or with you know, other forms of sort of, you know, other forms of sort of addiction. I think as a general rule, we're not going to be able to lend in those situations because it's not the right thing to do for the person, because at the end of the day, if that money is just going to help to feed that habit, then obviously we're not doing, I guess, ourselves as lender or them any favors by going ahead with that. So I think that's a good one to pull out. So obviously I think, in terms of sort of, should I borrow for this or shouldn't I borrow for that? I think, the thing to emphasize is that it is a really sort of personal decision, and it is based very much on what's important to you. But I think, when we were talking about this in preparing for today's session, Antony, you came to me, I think, and you had sort of five questions that people should ask themselves before they go ahead and borrow. So I wonder whether you wanted to sort of just talk us through those just briefly now.
Yeah, no, definitely. I think my sort of tips over sort of being in the lending and credit control sort of industry is, one of the questions I always ask straight away, and I ask it myself, is this purchase necessary? Am I gonna, if I make this purchase now, if I can't afford it, is it right for me to borrow money to make that purchase? I think when you can ask that question and get an answer, then you'll sort of know. And as I said, I'm not going to preach. It is individual cases. We all borrow for our own personal reasons. Then I also look at, actually, can I, for instance, if it's an appliance, do I need the high-end, top quality appliance when I could get a low budget one? Am I going to take out £1,000 loan when actually I only need a £250 to buy a low budget project? And then another question that I would sort of look into is, okay, I've gone for the higher product. Is this going to be affordable? Can I make the payments every month? It's very easy to take out money. It's harder to pay the money back. Might look good at the time, but actually in the long run, can I afford £40 every month or £45 every month? And then how quick can I pay it off? Actually, if I take out £1,000, is that going to leave me in hardship? Not right now, but 6 months down the line, am I going to go, well, actually, I need to pay for school uniform or another form of outgoing that actually I'm not thinking about now, but as it gets further into the year, I've got another expense that's going to come up. And then I sort of normally wrap it off with, what happens if I can't pay it off? That's always been my worry, that actually if I do something, am I unable to pay it off? And as I said, don't get me wrong, there's been many months before that I've maxed out a credit card and gone, actually, right, no, that's it, I can't afford it, not doing it, And I think it's about having that conversation with yourself to say, is this for me? Am I smart borrowing for myself? Am I doing it as an impulse, or am I doing it for a long-term goal?
No, I think those are all really important points. And I think what you said around kind of, looking for cheaper alternatives, I think, that's an interesting one, because obviously sometimes the reason people borrow is that so that they can afford the kind of perhaps the better quality or the longer lasting one. So I guess, in those sorts of situations, it probably would make sense to borrow in the long term. But I guess it's what you're saying about kind of, not necessarily kind of impulse buying and using credit to treat yourself, I guess, is the distinction there. Is that fair, Antony?
Yeah, definitely. I think using, am I going to borrow money because actually I want to go on a shopping spree? Do I want to renovate the house? Actually, are them decisions necessary for myself? Or am I just doing it because I can? And I think if you borrow money because you can borrow money, then it's not always the best. I think it's, borrow what you need and what I can afford, not what I can.
I think that makes a lot of sense. And so obviously the kind of, one of the key considerations probably, and one of the key things you should factor in, because I think the way you've put it there is really nice in terms of kind of having that conversation with yourself, and everybody will be having a different version of that conversation based on their own personal circumstances. But obviously a key factor there will probably be how much actually the borrowing is going to cost. And so I guess I wanted to kind of move on to talking a little bit about that, because, unless you are borrowing from a family member, or perhaps have an interest-free overdraft or something like that. In the vast majority of cases, borrowing money through any way you do it is going to end up costing you money and interest. And obviously we see APR listed. It always has to be listed whenever there's any kind of borrowing being offered. But there's often a lot of confusion, and it's not always clear what exactly APR is, what it means, how it's used. And so, without getting too technical here, Antony, are you able to sort of talk us through what APR is, what does it stand for, and what does it tell us?
Yeah, so your APR is your interest that is charged to you normally on a monthly basis. It's your annual percentage rate on your loan. I will say, I've probably been one of these people very early on in financial education myself. Probably I'd take out a loan very quickly, credit card, not really know what the APR was, knew it was a percentage, and if I went over, I'll be paying that, or I'll be getting charged that a year, a month. So really for me, it's understanding how much will it cost. If I take out £1,000, what is the cost of that £1,000 that I will be paying back on top? And I think that's, I think most commonly we see quite everywhere is, your standard credit card that you would get normally reaches to the 20-30%. And, we see that and it scares people, or they don't know what it is, so we just sign. So I think it's more understanding that how much will it cost me on top of what I'm taking out? I'm borrowing £1,000, and how much extra is that going to cost me to do that? And if so, sorry, go on.
No. And Lubna, I think you raised a really interesting point when we were talking about this earlier, which is that obviously the APR does matter and it shows up, but actually the other thing that people should take into account is how long actually it's going to take to pay back, because even at a relatively low APR, the amount of interest can add up. Did you want to say anything about sort of how that works?
Yeah, so looking at obviously the APR rates alone, you won't necessarily tell you which product is the cheapest. But for example, if you take out a loan with like a lower interest rate, then it could appear to be like the best option. But if you need to pay a higher arrangement fee, it could make it more expensive overall. For instance, if you were to take out a short-term loan, like such as a payday lender or a doorstep lender, they don't usually have any sort of regulations. You can take it out for a short-term one-off period, but it can go from 2 months to 6 months if you're not paying it on time. So you need to be also not only careful with like the company that you're taking out the loan from, but also how often you're taking it out. There's also several assumptions as well based on APR. For instance, if it assumes that if you pay basically your credit card balance in full each month, and that you won't be repaying your loan early. Also, it does not take into account such as late repayments or missed repayments. If you're obviously going over the credit limit, then that will not be included within the APR calculations.
So I think overall APR is important. It's a really useful tool for being able to compare different types of lending. But I think you're right to point out, Lubna, that it doesn't always tell you the full story. And I think the other thing to say about this particular stage in sort of today's session is that some of this stuff can get quite technical. But I think the thing to bear in mind is that regardless of who you lend from or where you lend from in the UK, if they are and it should always be a properly regulated lender, but under the sort of the regulations and the law in the UK, when you do take out any kind of credit, including a mobile phone contract or something like that, the full cost of the credit, as well as the rate that you'll be paying, needs to be itemized and made very clear to you. And so You know, you don't necessarily need to do all these calculations yourself. It's just a matter of being aware of it, and before you make the decision to go ahead, making sure you fully understand how much it's going to end up costing you, and if you need to, asking the right questions. So I think, you know, we can probably go into a lot more detail on that in a future session, but I think hopefully that gives you a kind of enough of the background around it. So I guess another factor which sort of affects how much you'll end up paying in interest is probably sort of, you know, again, it happens on an individual basis, but someone's credit history can affect the types of products that they'll be able to get, how much it will end up costing them, and things like that. And I think, you know, it's an area where we get lots of questions from people in terms of what can I do to improve my credit? Why is my credit less good than I expected it to be? All those things, and perhaps a few myths as well. So Antony, I wonder whether you could sort of talk us through a little bit about how credit history works and some of the things that might help it or indeed harm it.
Yeah, no, definitely. I think, you know, especially over the recent years and the pandemic, I think it's more of a conversation now, even with me and my friends. You know, we've all had that conversation. What's your credit score? Mine's this. It's quite a topic of conversation now. And I've always said to people, you know, have a relationship with your credit score. I'm not saying go out and marry it. I'm just saying be aware of your credit score and get to understand what your credit score is and what your credit report is. You know, they're two different things. And just have a general knowledge of actually my credit score is this. There's so many credit reference agencies out there now that, you know, offer it free. You can get it daily, you can get it monthly. I think also when you are looking to borrow, it does help knowing what your credit score is. I think it gives you a bit of you know, you can have a communication with lenders to let them know, actually, you know, I've got a bad credit score before applying. Is this going to work for me? You know, there is companies out there that specifically look at people with different types of credit score, whether it's very poor, fair, or good. I think, you know, some of the good things with your credit score that you will see when you start looking at it is that if you're paying on time, making regular payment patterns, you know, not just hitting your minimum payment every month. Actually, if you're paying your minimum payment plus an extra £10 every month, that's all going to contribute to your credit score and make your credit score look healthy. I think one of the ones that's always quite fascinating when you do speak to people is that the utilization of credit. And I think before this, we were talking with Lubna, and actually, you know, if you use all your utilization of credit that you have got available, it is going to affect your credit score. Every month, if you're, you know, got a credit card and you're at your minimum payment every month and you're spending £100, paying back £100 every month, yeah, you're still making a payment, but you're using the whole of your credit every month. It's not going to look healthy. It's not going to give you the best. And I think, you know, one of the ones that we've touched on, and I never knew this sort of as a, you know, when I was starting out with getting credit cards and stuff like that, was actually long account history. Actually, you know, having a credit card and having a loan and actually taking it over a longer period of time. But for me, it worked. It built my credit score. It helped me get to where I needed to be. I think some of the things you need to be aware of is missed payments, late payments. You know, that's very quick. That could affect your credit score. You can have one bad month that, you know, you don't pay anybody, and there's a couple of people on your credit file that are going to report missed payments. I think panic repayments, if you don't speak to lenders, you know that you're financially going down some hardship, and you actually then go, okay, I'm just going to pay them £25, then 25, but not communicate with lenders. That will take effect. And then taking out new credit, I think one of the ones that I've spoken to with members here and from other places is that you could look a little bit desperate if you apply for several loans, several searches, you know, oh, I really need a loan, or I need a credit card, and you spend the whole day applying for 10 different credit cards. It's not always going to help. It sometimes can damage your credit score.
That's really interesting. And I think, you know, I want to make sure that we have enough time for questions at the end. So I don't want to spend too much longer on this, but I think you make quite an interesting point there, Antony, around the sort of this whole sort of thing with utilization. So I guess what I take from that is that just because you've got a credit card limit or an overdraft limit of X, that's not a sort of, you shouldn't aim to be using that up every month or using the most of it, and that actually just sort of using just below or around half of that is going to help your credit score, rather than kind of regularly being near the max of that. Is that a fair sort of characterization?
Yeah, definitely. I think it goes back to, can I borrow and do I need to borrow? Do I need to make that purchase? Because I can doesn't always mean that you have to.
But the flip side of that is that if you're offered a higher credit limit and you trust yourself to not use it, that can actually benefit your credit score as well. But
definitely.
that obviously comes with a health warning that that's only going to work for you if you can trust yourself not to max it out. So that's a really interesting one. So I am aware of time, so I want to move on to some of the kind of some of the topics where we'll talk a little bit more specifically about how things work at London Mutual. And I think Lubna's going to come in on a few of the kind of the points here. I think the thing I would say before we kind of do go on and talk about those things is that at London Mutual, when you do apply for a loan with us, the final decision around whether or not we're able to offer you a loan is made by our loan panel. So that's a group of senior members of staff who will collectively make that decision, not the individual loan officers. And so Lubna works within our loans team, and she'll be able to give you some general information about how it works. But it's very important to be clear that Lubna is not the one that's going to be making the decision on this or on any other previous loans. So with that, bearing all that in mind, Lubna, did you want to talk to us about some of the criteria that we do use when we do make that decision?
Yeah, so how we make our decision is based on affordability, eligibility, credit history, and financial behavior. If you are eligible to apply for a loan, if you've already taken out a loan with us and you are a member, then we have a 1/3 loan policy. So you need to pay off a third of your loan in order to be eligible to apply for a top up. However, if you join as a non-member and you're applying for a loan and as a membership, then in order to be eligible, you need to be either living or working within the following 4 boroughs, whether it's Westminster, Camden, Southwark, or Lambeth, if you're in the armed forces and the health and education sector. In order to avoid delays, it was very important that we're able to collect the correct information. So we carry out affordability checks, which combines credit checks, evidence-based income assessment, whether that's a pay slip, self-assessment form, or universal credit breakdown, or in terms of expenditure assessment, that might be a bank statement. In terms of being realistic, we look at the debt to income ratio. So if you're applying for a larger loan, for a short amount of time, we need to basically assess whether if you have other outstanding creditors such as card bills, mortgages, or other existing loans, if it is able to tie in. So a low DTI means you have more room in your budget to take up more new repayments. We also carry out Equifax, which is our soft search. It does not leave a footprint on your file. Here we're able to see basically your credit file in terms of mail, if you have a mail order or a phone bill. We basically want to see if you're making payments on time. And if we do notice that you're behind on a payment or you've gone into a default, then we might question this. So we basically need you to be as accurate as possible. If you do notice that when you're applying for a loan that your credit file is not up to date, we recommend that you go on the Equifax website and you can get a free copy of your credit file and you can update your creditors. Yeah, and our decision is basically not personal whatsoever. We look at each and every single application based on the circumstances and the individual.
I think that's a good point to sort of to summarize what you're saying. I think you got those 4 different parts of the decision, and so I think the thing that I would want to get across is that when you borrow from perhaps high street banks or other lenders, very often they're using sort of an automatic process where they're going to go through some automatic checks, and it's going to be a case of computer says no in some cases, and there's nothing they're going to be able to do about it. I think the thing that makes us a little bit different, and the reason why sometimes it can take a little bit longer, is because as Lubna says, we are looking at we're aiming to get the big picture and fully understand your whole financial situation, so that we can make sure that it's right for you, and also of course that it's right for us and our other members. But it's really about kind of collecting as much of the information as possible to see the bigger picture, rather than perhaps just relying on your credit score or things like that. So credit history is definitely one of the things that gets taken into account, but it's certainly not the sole thing that the decision's made on the back of. So Lubna, just in terms of kind of how that process works, did you want to talk us through that?
Yeah, so in terms of submitting the application, we receive one of two. So we have members either coming into branch and filling out an application form, or they can do it online. Once we receive the application, we usually request for the documents. If you're employed, then we request for 2 months of bank statement and most recent pay slip. If you're unemployed and you have a current account with us, then we'll just basically use your current account statements. If you are in receipt of universal credit, then we'll request for the breakdown. Once we've received all of the documents, we'll send out a text, and you'll have a loan tracker, which will have an estimated completion date on it. That does not necessarily mean that you will get the offer and you'll get the loan agreement on the same day. So once you receive the loan tracker, it gets referred to the loan panel, and the underwriter that is responsible for it will be assessing the application. So what I've mentioned on the previous slide in terms of making a decision, they'll be looking at the affordability, if you're eligible, and also in terms of carrying out credit checks if needed. If, for instance, we do require additional information, then between the offer and decision stage, we might get back to you. So, for instance, if we do notice that there is gambling on the statement, or you're transferring money between 2 different accounts, then we might request for more information for that. Once we have received all of the information, it will get to the offer stage. You receive a text to say how much you've been offered, and if you'd like to accept it. Then we'll, once we receive the offer back, we have another team who deals with processing the loan agreement. So they'll be responsible of working out your repayments, and assessing in terms of what repayments are affordable for you. Then we'll send out your loan agreement, and it'll be ready for you to sign. You can sign it electronically, or you can come into branch and do that, whatever is suitable. And once we've received the loan agreement and it's signed, it will be processed for payment within 24 to 48 hours.
That's useful to know. And I think, all in, we usually say that's about 10 working days up to. Sometimes it can be faster than that, and then sometimes when it's running a little bit busier, it's a bit longer. Lubna, is there anything that people can do in order to hopefully sort of speed that up a little bit sometimes?
So I would say in order to get flow running and speed up the process, I would say once you make sure you're provide the documents on time, then it will be much more helpful back and forth and request for documents every single time.
No, I think that's a good point. I think I know that I see lots of people who sort of will take the time to fill out the application form, give us most of the information they need, but then they don't send in the documents that we need, and so the application gets stuck, and they get frustrated, and it means that we can't take things forward. So I think that's a really important one in terms of making sure that your documents are provided as soon as you can get those to us. So just before we go over to questions, I think that's probably just about enough talking from us. But just to wrap things up and summarize, I just wanted to talk a little bit about some of the kind of the tips that if you are looking and thinking about applying for a loan with us, some of the tips for preparing your application. I don't think we need to go through each of these one at a time, but Lubna, Antony, I wanted to know whether you wanted to sort of pull any of those out or draw people's attention to any particular ones of those.
Yeah, I think the one that I always, from a credit control perspective, is be honest. Give us the full story or the whole story. I think that's key to speaking to a lender, that actually I'm in this situation because of this, and this is my debt, and I either need a loan, or my saving goal is this, and this is why I'm taking out a loan. I think that's quite a realistic approach for yourself and for the lender.
Lubna, any of those that you wanted to sort of draw to our attention?
I would say start small if you're building credit. If you're taking out a personal loan, then it can help to improve your credit score. But if you make your payments on time, then it'll be helpful. But otherwise, it can hurt your score if you're taking out multiple loans, multiple credit cards, especially if you have a history of missed payments on other debts. Also, get your paperwork sorted. We don't want to be constantly sending emails back and forth, requesting for documents. If you're able to submit it on time with your application, then it can be a smooth process.
I think that's a point which always bears repeating there. Give us the information that we need in order to give you the best chance, and to be able to make a decision nice and quickly. So that's things. The types of documents we're going to be asking for are pay slips, bank statements, basically kind of evidence that your income and your outgoings are what you say you are. And if we've got all that information, then fingers crossed that usually the loan application process will go very smoothly. So that just about wraps up all the kind of the content of the masterclass today. I think we've covered a lot of ground and touched on actually some really interesting topics, which I think potentially we can probably explore in a little bit more detail in future sessions. And if there are particular things that you would like to hear more about, then you are always welcome just to drop us an email to make some suggestions. And again, we'll include that in the kind of feedback survey that will be going out to everybody who attended today's session live. But without further ado, it's over to you for questions. Type them into the chat below. I've provided a sort of a screen grab with the button to press there, so feel free to type your questions into there. And myself, Antony, and Lubna will pick up as many of them as we can. Any that we're not able to answer live today, or where we may need to get back to you via email, feel free to email them to us at feedback@creditunion.co.uk, and we'll follow up with you. But we've probably got maybe another sort of 10 or 15 minutes or so to answer any questions that people might have put into the chat box. So I can see 9 messages there. So let's see what we've got. And Antony and Lubna, feel free to sort of pick up any that you would like to go ahead and answer.
So I can see one where Max King has said, documents, if emailed over, these contain bank information. So can we password protect and send password separate? We don't usually accept password protected documents. It's just for internal purposes. Like, we want to make sure that we're able to open up the documents in the first place. We don't really want any sort of password protected information.
I think the other thing I guess I would add on to that is that obviously as part of the loan application process, there is a secure document upload page. So assuming that all works, that side of things all works smoothly, there should be no need for sensitive documents to be sent by email anyway. And that whole kind of document upload stage of the process, we're working on kind of redoing at the moment to make it even more simple and straightforward to use. Antony, any kind of questions you wanted to pick up on?
Yeah, I think there was one quite earlier on. I think it was from Nicole Williams. He was on consolidating existing debts. In the past, you have found that the APR rate or interest rate has been much higher than credit cards. I think with that, I think it goes back to what Lubna was saying earlier on. It all depends on the length of the borrowing. Are you borrowing 10K over 5 years to 10 years? Your interest rate is going to change and your APR rate will change. Depending what lender you go with, you could go to a Barclays bank, you could go to us, you could go where everybody's going to have different interest rates for their products. It's finding the best product and interest rate for your current situation. I think that's probably more looking around that actually, don't always be scared to go to just one, have a look around, you've got to work out what's best for you, not what's best for the lender.
I can see one here from Moses. He asks, "What is the best credit score?" Now, I know that's a little bit more complicated because, as I understand it, there are several different credit referencing agencies, and they all use different scoring systems. Is that right, Lubna?
Yeah. So we use Equifax as well as Experian. If you do want to get hold of your credit file, then I would suggest that you log on to or go on the website for Equifax, and you can get a copy of your credit file. If you want to find out more information about all of your creditors, if you want to also update your credit file and reportings, then you can do that.
Great. And I received actually one directly to me by direct message from is it Denir, and apologies for pronunciation of your name there. It says, "I used to work at a particular hospital, now work for a different trust, but they're unable to complete a loan application online, but they still work within the NHS." I think the thing to say there is that London Mutual, we obviously cover those areas of central London and within Greater London. We only offer the kind of the salary deduction loan side of things with certain NHS trusts. So you may live within our general area, but if you work for a different NHS trust, you'll still be able to become a member. You'll still be able to apply for a loan with us, assuming you live or work in one of our boroughs. But we may not be able to offer the option for you to make your repayments directly from your salary. I think the other thing to say there, and again, if you'd like to email, we can certainly look into kind of your specific case and help you and see what your options are. But I think, the other thing to say is that we work on the principle of once a member, always a member. So that means that if you join us and become a member when you work for a particular employer or live within our area, if you then end up moving, working somewhere else, or you move out of the area, you can still remain a member of London Mutual, and so that gives you the flexibility. So in a way, it's impossible to leave us unless you actually make the decision that you want to leave us. A little bit like the Hotel California, but hopefully a little bit friendlier. Next question is from Max King. Would like to know, do we have an app? I don't know, Antony or Lubna, whether you wanted to pick that one up.
Yeah, sure. So if you are a member with us, we do have an online banking app, which obviously gives you the main functions for your account, paying, setting up payments, repaying loan payments and stuff like that. We also have it online. It's online banking. You can do it through a website as well. So yes, we do have an app. Most of our loan products you can see online. We do have loan calculations on there as well to give you a rough estimate of roughly what you'll be looking at. So yes, we do.
That's really useful to know. This is an interesting one here from Naz. Naz would like to know, do you need a history of saving with the credit union? And if you do need a history of saving with the credit union, will that help your application for a loan? So Lubna, I don't know, do we take into account people's history of saving with us?
We do take into account the history of our members, but it does need to save large amounts of money. You need to have it each month because we're able to basically assess that you have a good history of saving, but also it's a small portion when it comes to making a decision. So we'll be looking at the history, but also we're also looking to see if you're good at saving, and also you're able to maintain your other debtors or creditors that you might have by looking at your bank statements. So it all entails everything in terms of assessing your bank statements, looking at your history with us, whether you're making your payments on time, and your saving.
Great, that's useful to know, Lubna. Just a couple more. I think a couple of people have asked whether or not this session has been recorded and whether that be available. Yes, the answer to that is what we tend to do is we'll try and get that sort of get that sorted up on YouTube. If not today, it'll be by the end of the week. And as soon as it's ready, we'll be emailing the YouTube link around to not just people who are watching live today, but also everybody who registered and who perhaps for whatever reason wasn't able to join us live. Yeah, so you'll have the opportunity to watch it all over again on YouTube. Final question, I guess. Another one from Max King. How do we upload, please? I think that's a good link. Yes, yeah, well, easy answer there, isn't there? So when you get to that stage in the loan application process, if you didn't provide your documents at the same time you applied, the loans team will email you with an email that's got a big green button saying click here to upload your documents. If you haven't received that, do let them know, because things do sometimes go wrong. And I think the other thing to say is that we are working over the next few months to try and make that process as smooth as possible, and we'll be announcing some improvements to that as well. So I think that's just about everything we've got time for today. I think so yeah, I think it all comes down to thanking you once again for joining us today. I think, you know, as I say, this is only the second time we've done this, so it's great to see you know, such a large number of people that have tuned in to see us, particularly on a kind of a lunchtime. As I say, you'll be able to watch it again on YouTube, or to share it with friends. And I thought it was really interesting topic where we touched a really interesting session where we touched on some interesting subjects. Next month, we're going to be zeroing in a little bit on membership here at London Mutual, and specifically how to make the most of it. So if you're interested in various other things that are on offer, so if you're saving with us at the moment and you're interested in what kind of loans that are available, or indeed if you borrowed with us in the past and are looking to go down the savings route, or if you're interested in different ways to access your money, whether that's through the mobile app or online banking, or using text, we can explain all of that through that session next month. And we may also be in a position to give you a little bit of a look behind the scenes, and to give you a sneak peek at some of the kind of exciting new products and features that we're working on at the moment, and which might become available over the next few months. So do tune in for that. As I say, we'll be sending around a feedback form, and it's really useful to get your feedback on how you think today's session went. Always nice to see if you found it useful, or if there were bits that you found less useful. And apart from that, I'll thank you once again for coming, and wish you great rest of your week. So thanks very much, everyone, and see you soon.